It's time for CIBL Biz Tips, bringing you actionable strategies to grow and improve your business. Prepare to become civilized.
What's up, Central Illinois? Welcome to CIBL Biz Tips, where we bring you concepts and strategies to grow your Central Illinois business. Today, for the final session, we have back in the Zoom recording studio, John DeFreitas and Nick Gentile of Heartland Bank Trust in Springfield, Illinois. If you were with us last week, we talked about how to start in the real estate investing world and what to expect when you go to apply for your first loan for your investment property. Today, we're going to talk about the difference between a typical residential mortgage and a real estate investment loan. So it sounded like Nick kicked it to John already. So John, what is the difference? What's the main difference between a mortgage for a home that you're living in versus a real estate investment loan?
Yeah. So first of all, one of the things, you can get a traditional loan on an investment property, but not if you have a business name. So if you have an LLC or a corporation, you can't get a Fannie Mae loan. So you can't walk in and get a loan from a mortgage officer. That will have to be a commercial type loan. So but even within Fannie Mae, there are some different rules. I think you can only own a handful, 5 to 7 investment properties in your own personal name. And before you have to start going to a commercial loan officer.
Okay.
So that's a big one. If you're planning on opening an LLC, which is very common for real estate investors, then you have to work with a commercial banker.
Excellent.
So I'd say the number 2 thing is probably terms. You can walk in and purchase a house with very small amounts of money down and also probably get 30 years, no problem. Whereas with a commercial loan, the longest on a single family home, you're probably looking around what we call a 20-year amortization. And the difference is on a 30-year loan on your house, you have that loan for 30 years. But on a commercial loan, typically we're going to do that in 5-year terms. So you can get a fixed interest rate 5 years at a time, but we'll make the payment match a 15 or 20, maybe even 25. It's a really big investment. We'll make that payment match that amount of time, and that's what we call amortization. So it might be a 20-year amortization. So you might, on a 20-year loan, you might have to renew that loan 4 times or 3 times to get to that full amount of term of what you would have paid over 20 years. That makes sense.
Plenty of sense.
Okay.
So I do have a question, John or Nick. So you mentioned you can sometimes qualify for a personal loan for a real estate investment if you are not in some type of an LLC structure. So it's you individually. So in that case, would I qualify for a lower down payment potentially?
Yes.
Perfect. Okay.
We are not mortgage officers, so I don't know what that amount is. You're going off of Fannie Mae's investment guidelines at that point, which are separate from a regular home mortgage, but totally different again from a commercial loan. I know the numbers are different, but I don't know them exactly.
Excellent. Okay. So if someone does that, I guess we asked this when we talked about lines of credit. What is a starting rate interest rate look like for, since you're not a mortgage person, for a commercial loan today? And I know it's going to be a moving number, I'm sure, for, let's say you're a better than average investor that comes in. What are you kind of starting at right now?
That's a trick question. Like we talked about before, it's going to depend on a lot of different factors, but you might be able to see something that starts with a 6, mid to high 6s, probably. I've seen different rates floated out there around town. it just really depends on the deal and who the investors are, how much is being put down. Even could be the same investor on a different property could get a different rate, or the same investor, same property, different amount down could get a different interest rate. If you're willing to put 30-40% down, we might be willing to give a much better rate because all of a sudden that risk is a lot less.
Okay.
So it really varies, but I would say, for a regular investor, don't be surprised if nowadays it starts with a 7 even.
Yeah. Okay.
Right. And more often than not, those rates are moving. The commercial loan rates and the mortgage rates are moving in a similar the same direction, but at a similar pace.
Okay.
Now they're not always the same. I think historically in my experience thus far, the mortgage rates have been lower, the residential mortgage rates, whereas the commercial mortgage rates have been a little bit higher, but the margin, the gap has not been too significant in my experience. But if you see that rates at your local bank for a 15-year, 30-year residential mortgage are going up, assume the same thing's happening with commercial rates.
Okay. So
I should also mention that, sorry, real quick, that typically, and here in our office at Heartland, your commercial bankers, your commercial lenders, and your mortgage lenders typically work really closely together and have for the most part good relationships. So if you've got somebody, and if you're not even 100% sure, regardless of where you start, more often than not, they're going to help you navigate that process and figure out where you're going to end up. So we have that happen all the time. John and I both work with the mortgage lenders. We have 3 of them here in our office. And if somebody's, in a situation where they could go either way, they could get that as a personal residential mortgage, or they could come to the commercial side. We usually talk to them about what are the pros and cons of either option and get them to the right place.
Awesome.
Yeah, it could come down to the decision being made by their accountant also. They
Yeah,
might say, you need to have this in an LLC, or you need to have this kind of term to make this work, so you need to go down this path instead of that. So,
okay. So that kind of leads the question that I had. Let's say someone applies and they get the loan in their personal name. And then a year or 2 down the road, they talk to their accountant or attorney and they say, hey, we need to get this moved into an LLC right now. What does that do on the loan side? Is that going to change the way that the bank looks at that loan, or are they going to have to, refinance in the name of the LLC? How does that work?
Yes, they will. And that actually happens quite a bit.
Okay.
And for all kinds of different reasons, but because technically the owner of that property is going to change. If the ownership structure is going to change from a person to a business or vice versa, that almost always, and I would argue maybe even always, would require a refinance situation with the bank.
Okay.
Yeah, and even though, or what we call a modification, which to the end users is basically a refinance, but your loan number might stay the same, and your interest rate could stay the same, especially if this was all done in a relatively small amount of time. Sometimes guys jump on something, they haven't formed the LLC yet, and they need it purchased right away. Or they decide to go with a series LLC instead of a regular LLC, or just there could be a lot of different reasons why. But it might just be on the user's end of things. It might just be coming into the bank and signing papers again, which they would probably think of as like a refinance. But on our end, it might just be basically we just need to redo all the paperwork, redocument it. We might have to file the mortgage again with the county, things like that, so that you'll probably have to change your insurance over, things like that, so that the business owns the property now and you don't own it individually, or vice versa. We've seen it go both ways.
Okay. So it may or may not impact your interest rate on that loan then.
Maybe not, especially if it's higher when you got it and it's lower now.
Sure.
Yeah, it definitely won't.
Right. Well, if you're, we'll see if that happens to anybody, at least now. Yeah. But if rates come down, like they're saying they're going to in the next year or 2, maybe that's something, if you've been wanting to put something in an LLC and you've been waiting for that, maybe that's, that'll help people. So,
yes. So that brings up a good question that we have not talked about. a big, huge difference between investing in real estate and buying your personal mortgage is something called a prepayment penalty. And so banks, especially right now, with higher interest rates, they want to protect their investment, right? We're investing in you, and we might be charging 7%. Well, we want to earn that yield that we put that money into, right? And so if tomorrow interest rates dived back down to the 4s or the 3s or something like that, and you say, well, I want to refinance. Well, there's a very good chance that your loan has what's called a prepayment penalty built into it. A common one would be like anywhere from 3 to 5% in the first year. So if you refinance that, took it to another bank, whatever that might be, or even just paid it down with cash in that first year, you might have to pay a 3 to 5% penalty on that. And typically you're going to see that go down and maybe even eventually go away. Some of them stay on for the whole term of the loan. So it could be like a 5, 4, 3, 2, 1, where each year it goes down a little bit, and then maybe it stays at 1, or maybe like the last year or two, it goes away because we've already earned the majority of our interest at that point. But a lot of them even if there's not a prepayment penalty, there's like a minimum amount of interest that you're going to pay. So it could be $200 or $500 or something that no matter what, if you pay that loan off early, we need to collect some interest because all the work we put in up front.
Yeah. So that was actually a question I was going to ask you. A common term that a lot of real estate investors use is BRRRR, the BRRRR method, if you guys are familiar with that. So it's BRRRR. So buy, renovate, rent, refinance. So that's what people will do. Obviously, going back to John's $30,000 property. So if you buy a property at $30,000, you renovate it. Now the property is worth $70,000 because you've updated all the mechanicals and added different flooring, that type of stuff. They rent that out, get someone in there, and then they come back to refinance because the property's at higher value than what it was when they initially applied for the loan. How quickly can they do that? And how often do you see investors do that? And is it a good thing or a bad thing in your eyes for people doing that? That was a loaded question.
Yeah, it's a tricky question. So sometimes we do those in the form of a construction loan.
Okay.
In the line of credit episode, Nick talked about a straight line of credit, we call it, where you borrow up to a certain dollar amount and then we term it out. So if you know that this house is going to need $50,000 in renovations right away, a lot of times we'll do that on the front end. We'll plan for that ahead of time. You might have an interest only period for 6 months while you're doing the renovations, and you'll borrow up that money. And then when you get to the dollar amount that's finished, then we'll term it out. And sometimes we don't really see that right now. We don't predict that a lot of real estate investments are going to have like a huge increase in value within the same year, or, we don't know where they're going to go exactly. But, if I redo this house today because of the market right now, it's not necessarily going to come back with a huge value unless you do something major, like add a ton of square footage or something. So there may not be, like the good old days, a lot of extra equity that you just built up immediately. It might just be worth improvements plus a small percentage.
Okay. Gotcha.
And I think it depends on the level of investor too. I've seen plenty of investors that do that at a high level, and they're very comfortable with doing it and being leveraged up as possible on their properties and having as much debt as they need to keep going and keep growing. But if you're a novice investor that's still getting your feet wet in that world, if you're talking about a $30,000 property versus $70,000 property, you could also say on the other end of things, having a $30,000 debt feels a lot more comfortable for me than a $70,000 debt on my balance sheet. So there's give and take there. That's why John said it's kind of a tricky question. I think it's one of those where if you've done it a few times and you get really confident with it, and it depends on the person for sure. It depends on the property too, but definitely see different levels of investors out there. So seen a little bit of both.
Sure. Last question, and this is kind of it has nothing to do with anything. I'm interested in seeing the answer. Are you seeing many people use like a home equity line of credit to invest into some type of a real estate property for that down payment for that new property? Have you seen that very often?
It happens. I would say banks want what we call some skin in the game, right?
Mhm.
We want real cash into a deal. Say you don't have any cash and then you borrow money for the down payment. Well, that's still dead on that same property, really. So really you're 100% maybe lent up on that piece of property.
Mhm.
And the other thing is something bad happens to that property, or you have long-term vacancies. Where is that person going to come up with the additional funds to support that loan payment later?
Mhm.
So really, we like to see somebody not only with just putting cash in the deal, but also having some reserve funds, 3 months, 6 months worth of cash on hand,
Sure.
and knowing what those expenses are, knowing what the insurance is going to cost, have some real ideas of what the utilities are going to cost or any carrying costs that they're going to have, and have a real idea of what vacancies are. I know it's kind of messed up right now because rentals are really pretty full. You don't see a lot of vacancies out there unless it's a really bad property. And so you might say, well, I have 0 vacancies. Well, that might not be true tomorrow. So we want to know that that person can withstand some sort of downturn and keep making that payment, even if the cash flow isn't coming in.
Perfect. Well, I feel like we've hit a lot of topics in this last episode. Anything before we jump off of here that you guys want to share? You feeling good about it?
Yeah.
Perfect.
Feeling good. Glad to come back on.
Yeah. Well, happy to have you guys on. And for one last time, if anybody's interested in diving into the real estate investment game, how can they reach out to you?
Yeah, heartlandbankandtrust.com, or give us an email, phone call, or stop into the MacArthur and Ash branch here in Springfield.
Perfect. Nick, same?
Same thing. Yeah, look us up on the website, or we've mentioned LinkedIn quite a bit too. It's an easy way to get a hold of us if you just want to shoot us a message on there and connect with us. It's a ever-changing world, real estate investing. So definitely find the right people to talk to and ask questions of. But happy to help anybody in any way we can.
Awesome. For all you listeners out there, make sure you're subscribing to the CIBL podcast on your favorite podcast platform. While you're there, leave us a review. It'd be greatly appreciated. You can also find us on social media, mainly Facebook and LinkedIn, and connect with Garrett and I there as well. Until next time, y'all been civilized. Take care.
Thank you for listening to this episode of the Central Illinois Business Leaders Podcast. You can find us on Facebook at facebook.com/CIBL podcast. You can also follow us on LinkedIn. Don't forget to subscribe and leave us a review. It's the civilized thing to do.